This is Top Shop Podcast.
Top Shop Podcast.
A show way beyond the story. Get ready to accelerate your knowledge and stay ahead of the competition. Podcast for automotive service business owners by Paul Donahue.
Welcome, everybody. On today's Top Shop Podcast, I've got an awesome guest I've been wanting to get on the show for a while. It's Todd Rooker, Rooker Financial Services. Todd has a master's in business administration, and then he got a second master's in actuarial science. After he graduated college, he built a financial services firm and sold it for $16.3 million. So he also has been doing a podcast. He's done thousands of podcasts on an amazing number of topics, but it's the number one podcast on ESPN, 13 years running. It's also the longest running financial, not only the top, but also the longest running financial podcast on ESPN. The reason that he's a guest for you shop owners is because it doesn't matter whether you're a dentist and you look in miles or whether you change tires, okay, and do oil changes. He's taught me and my wife also is how to take profits from our business and turn it into real wealth through real estate. So I remember a dentist that I told Todd about a long time ago that in Tampa, and he told me flat out the only reason he looked in people's mouths was to invest in real estate. And back then he had over 100 homes. So, and it was all managed by some people. So, he didn't run around fixing toilets and doors and, he had a management company that took care of all those properties. So I'm sure that dentist retired really, really well. And this is what Todd has been teaching for a long time. Now, it's not one of this no money down stuff. It takes money to make money. Todd works with Todd only works with certain clients. But one thing for sure he does know how to do is a very systematized way of purchasing single family homes, one of the safest investments in America, and turning that into a 22% and higher return month after month, year after year, no matter what the economy is doing, whether it's up, it's down, whatever, he gets that 22% plus every single year, year after year. So he really knows what he's talking about. So without further ado, Mr. Todd Rooker, Rooker Financial Services. Hey, Todd, thanks for taking your valuable time to be on our show today.
Thank you, Paul. Also, the longest running financial show on ESPN radio. It is a podcast as well, as Paul has said. And investing in real estate is really more not about investing, but owning physical assets. I own one of my buildings. It's a 24-unit apartment building. So whether it's multi-unit, whether it's commercial, whether it's single-family homes, it doesn't matter, provided that the numbers work. But I think business owners, as you have said, and I'll just add on to it, they neglect to recognize that the real goal is to own physical assets. Some people who are financial people see that as problematic in that it slows things down because they want to be more agile. Nevertheless, the ownership of physical assets in the end has enormous value in terms of growing a business because you've got a physical asset that they can leverage and use to expand and get expansion business loans. It's just a multitude of things. But a lot of small business owners, small to medium-sized business owners really don't even know that they should do that. And so it's not even on their radar screen, Paul.
Okay. So Todd's website is coveryourassets.money. That's coveryourassets.money. It'll have links to all of his podcasts on there. So, okay, great. So, hey, Todd, I guess one of the first questions I should ask is, you talk about 401k thinking. Could you tell me and the other shop owners that would be listening, what is 401k thinking and why should we avoid it at all costs? Because Todd immediately notified me that I was a 401k thinker. So but
we're working on it.
We're working on it. So go ahead, Todd.
So, yeah, I mean, look, 95% of the population thinks this way, and it isn't so much that it's a bad thing so much as it's limiting. And remember that if you're a business owner, chances are you already seek to have control over things. If not for that, you'd not probably be a business owner, and certainly not a successful one. But 401k speaking is really a disease in that you've bought into all of the things that you've been taught since the time you were a little, which are more often you wanted to be a thing. Hey, what are you going to be when you grow up? You're going to be a fireman, you're going to be an attorney, you're going to be whatever. And so you seek to become a practitioner, as opposed to an entrepreneur who is a financial person who just happens to be in a particular industry. If I own a body shop, I don't want to be called a body man. I'm an entrepreneur, and my business happens to be being in that industry. Now, I might sell that business, position it for sale, sell it for several $1 million, take a little hiatus around the world for a year, and then I come back and I start or purchase another business, and I do it all again, regardless of the type of industry that it's in. That's what you want to seek to do. That's not something that's on most people's radar screens because they begin as practitioners and they define themselves as such. Additionally, you're looking for a lifestyle. And as a result, your whole world is about lifestyle. You know, Michael Gerber, who I've actually been on stage with, wrote the E-Myth, and he talks about the primary goal of a business is to enhance the lifestyle of the business owner. Well, here's the reality. I know that that is what most people buy into. I get that. But the reality is I don't think that way. I believe that a business has to have something unto itself, and your goal is to grow and build that business regardless of your lifestyle. And you find that the most successful people in the world really have little interest in the lifestyle things. They live and breathe their business, and the amount of time, hours, and money they put into it is irrelevant because they're utterly focused. And so for you as an individual, if you're at the neighborhood party and I say, how you doing financially? Imagine me actually saying that, right? How offensive that might be.
Right.
But I'm a little drunk, right? And so you answer by telling me about the multi-million-dollar house you own in a particular neighborhood of town. You tell me about how you just built an addition or a porch on your house. You tell me about how your kid just got accepted to Harvard. You tell me about the brand new BMW that you have, the Louis Vuitton handbag that your wife has, and the trip you took to Europe. Well, I got news for you. That has nothing to do with how you're doing financially, but that's how everybody measures themselves, and that's one of the reasons they don't go very far. So when I talk about you speak 401k, has nothing to do with whether you do or don't have a 401k. It has to do with you are utterly focused on lifestyle. That's all you think about. And when you grow the business and grow the profits of the business, you're already tying it to the things that you can do that enhance your lifestyle. And that's why your business doesn't grow, because you're all focused on that. Now, it doesn't mean at some point that you don't want to have nice things, cabin, house, whatever it is, but you have to delay that gratification so that that investment, that business, that money, that resource that you have takes on a life of its own without you. That's the goal. You know, broke people save money and rich people invest money. Well, what do I mean by that? Broke people tend, when they make a profit, they either one, buy crap, forgive me, they buy shit. And all of those things are decreasing and assets that don't make them any money. So when you buy an asset, the question is, does it appreciate? Is it appreciable? Does it make me money, or is it a liability? Well, I got news for you. All the things that I just mentioned. I got a new boat. Hey, man, I stroked a check for $150K to buy a boat. I own a cabin. I got a new car. I spent more money on the house than the neighborhood will support. None of those things are investments. But see, broke people save their money to buy shit. What's the next thing they do with it? They put the money in the bank and draw off of it. Or they pay down debt. Or lastly, if they're smart, maybe they buy real estate. So the first three things, if that's what you're doing, you're going nowhere. And the profits of the business aren't actually creating something of themselves. You're simply using them to support and enhance your lifestyle. And when you're done working, the money stops too. So if you want to speak 401k, you got a lot of company. 95% of the population who are employees, they all think this way. And they don't know why anybody wouldn't think this way. And if you say, screw you, that is the way I think, and there's nothing wrong with it, because it beats the alternative of being broke. I don't disagree with that. But the fact that you make $300, $500, $1 million a year by no means means that you are well off financially. Net worth is how you measure yourself. That is to say, assets that you own minus liabilities that you owe money on, and whatever is left, that's your financial standing in the world, not your earned income. Just ask any professional athlete who's broke 5 years after they were a superstar, and they'll tell you how that works.
Right. So that's an excellent, excellent explanation. So what's the next step? So I know that I want to start taking a look down the road, 10, 20 years down the road. And I think, what's my first action step that I should take to change that? Because as you've told me before, it's amazing what you can get done in a decade investing in single family homes, real estate, or fourplexes or whatever. In 10 years, it's amazing. And then you borrow money from the bank, that's the bank's money. The renters pay the money back, plus give you a 20% profit. You got no skin in the game, basically. So, and then at the end of 30 years, you own the property free and clear. And by the time you go to retire, sell your shop. Not only do you have the income from selling the shop, but you've got the income from your rental properties, where if you want to live on cruise ships 6 months out of the year with your wife, you've got the money to do it, right? So what's the first step to get started?
Well, let's begin with the presumption that whoever's going to watch this, Paul, is somebody who is probably in a business. Let's begin with that premise. Yep. So if that's true, there's a lot of business owners who have nothing more than a job, and most of them will deny that, and you who are listening might very well be doing that. But the reality is that if I ask you how much your business is worth, you can't tell me, because you have not been building a business preparing it to be sold. You have this goofy notion that you're in a business and you should own it for 30 years, which is categorically wrong. You should never write a business plan for more than 5 years, and it should be a marathon, or a sprint rather than a marathon. You run as fast and hard as you can, and then if you don't sell it, well, then you apparently chose to buy it. But it's an asset that has an asset value unto itself. Well, when you worked, if you ever did, for someone else, you got paid earned income for the work that you did. In the business that you own, you probably get that too. However, what makes you unique, if you look at it this way, is that while you're getting paid an income, just like the people who work for you, you are also building a business that has an asset value unto itself above and beyond your income. Employees don't have that, do they? But the time to be worried about that is not 30 years from now. You need to be building the business, understanding how it's valued, and just understanding, going online and figuring out what EBITDA is, earnings, interest, amortization, blah, blah, blah. That is not how you look at a business, because there's a different industry that might be a distressed industry. What will a bank finance it? I've been doing business valuations for 25 years. So if your workforce is aging, all these things have an impact on the value of your business. Well, wouldn't it be great to know that, so that you build a business in such a way to enhance its value as a saleable asset? So that's the first thing, Paul, to be concerned with. The next thing you have to realize is, if your business requires a space to occupy, in addition to the earned income, in addition to the fact that the business has its own value on top of the money that you pay yourself, now, if the business requires a space to occupy, why would I rent that when those rent dollars that I pay could otherwise be deployed so that that business, as an offshoot, could buy me an asset that I own? And know that when I buy a building, commercial building, that I don't occupy, that's totally different in the way that I look at it as compared with if I am currently paying rent. Because what makes for a good investment isn't this is the best thing out there, like most dum-dums think. A good investment is simply better than what you would otherwise do. You might say to me, hey, Todd, what's a good investment? Well, if I tell you something and you say, yeah, that's great, but I never do it anyway, what meaning does that have? The real question is, I don't know if this is a good investment for you. What would you do instead? Well, if what you would do instead is paying rent, if I could take those same dollars that are dedicated to rent as a write-off on my business, and each month that payment paid down simply $1 on the balance of the loan, something that I did not get as a renter, am I not ahead of what I would have done otherwise? Right? Mm-hmm. Now, in addition to that, if I buy and purchase a building and I position my financials so I can qualify for the loan. See, that's important. Having an 800 credit score does not mean you're getting a loan for a commercial building. If you don't understand things like debt service coverage ratio, how you need to make it look, and not listen to your CPA to write everything off as expense so you show you have no profit, now you have no capacity to qualify for the loan, well, you're never going to buy a building anyway. So one of the biggest mistakes people make is they think a CPA is their business advisor. Categorically incorrect, but there's so many other dum-dums who think it is that apparently if enough dumb people say the wrong thing enough times, it's common knowledge and everybody thinks that's the correct way. The reality is, if I am positioned to buy a building, I can take and purchase a building that maybe is 4 times the size that I need, take on 3 tenants who are logical referral sources for me, I, them, they, me. And now there's a value add for all of those businesses to be under the same roof. And now, having been the person who, or the business who purchased that building, I'm taking my rent and their otherwise rent, which is now purchasing a building for me 4 times the size of my rent dollar would pay for. And now I have leverage. Now that business is, one, creating an income, just like if I were an employee. It's creating an asset value for sale in the value of that business, and it's purchasing real estate for me all at the same time, where before maybe all it was doing was giving you an income stream. Most small business owners don't even know they should be looking at things this way, much less positioning to do it.
Right. So you're preaching to the choir there and positioning for. That's what I tell our clients. One of the main reasons that they want to invest in a digital marketing growth program is to rank higher on Google, because a business can be worth, a shop can be worth $100,000 to $250,000 or more on the open market. If they're selling that shop and say, oh, look at our position on Google, we're number 1. If you type in auto repair, my city, I rank number 1. We get all the business referral from Google. So I've talked to several business brokers, and they said, you know, the amount that a business can get over and above their company when they go to sell it if they rank first on Google. So it's the same thing with you. You know how to position a company to go to a bank or to position it for sale. So so if I'm a shop owner, I'm busy doing it. What's my tell us about how to get started in, because if I'm running a shop, or I'm running a digital marketing company, or I'm running anything, man, I don't have time to be digging through One Ads or I'm going to be digging through Zillow trying to find houses. How would I get started? Would I have somebody, a spouse? Would I have a family member? Would I have somebody? Would I do this on weekends? Would I dedicate so many hours? Do I have to do it myself? How would I get started in understanding what it takes to start buying single family homes on a consistent basis? So over time, I've created wealth through real assets. And by the way, what Todd is talking about, I can tell you right now, the upper 1% of income earners, and the ones that are earning $1 million and more per year, they're dumping cash like crazy. They're buying real estate. They're getting rid of the US dollar, and they're buying real estate and hard assets. They want to make sure that they don't have anything. Dollars sitting in the bank is kind of not smart nowadays. So people that are saving money, inflation is going up much faster. So they're losing money. So and I'm one of them. I will not keep cash in the bank. I would rather have hard assets in my safe that I can touch, like gold and silver, or a real estate investment. Well, what would be a plan for somebody to get started?
Well, so everybody needs to be conscious of why they should spend less than they earn. Because I'm telling you that even though people are business owners, they've got an S corp or they've got an LLC and they own whatever, they all think like 401k speakers. I mean, the fact that you own a business or have a business doesn't change that, because you've been indoctrinated into that. And everybody you know and everybody you grew up with probably thinks that way. So do you. So to you, Making more money simply means that you have more stuff. And that's also why the businesses don't succeed, because rarely does a business succeed simply with organic profits, at least not to any real degree. You generally need to have financing to be able to cover a burn rate while you're paying people as you're growing more equipment, more people. And those people are costing you more money in the early months than they're making you. And you have to be able to support that ongoingly because your business is always on the grow. It's either declining or it's going down. I coach people on building companies every day. And the reality is they think they're going to buy all the things that they want to have and still have plenty of money to invest. And that's why their business has 10 or 20 employees. And that's as far as it's ever going to go. And you know what? Beats the hell out of what everybody else does. So they're happy. But if you want to go farther, it's going to take financing to do it. So the reality is, to be able to accomplish that, qualify for that, you have to show that you spend less than you earn. The fact that you actually pay yourself $500,000 a year doesn't mean anything when you go to qualify for commercial financing, because that's totally different than when you go to qualify for your home. Oh yeah, my bank will give me money for anything. Yeah, that's because you got, hundreds of thousands of dollars in equity in your home. When you go to buy a commercial building, it's an entirely different thing unless you want them to collateralize all of your other assets. So you have to understand how that works. Well, if I spend less than I earn, that means that I'm not taking every dollar that the business makes and immediately thinking about all the crap that I can buy with it to enhance my lifestyle. Well, if I do that and I can show that I'm making more money than it takes me to live, and remember, a bank assumes that if your business in a profit mode makes you $350,000 a year, and at the end of the year you've got $20,000 left over, the bank assumes that apparently that's how much it costs just to support your lifestyle, and none of that money is considered to be money that you could use to qualify for a loan. And they're going to look back over the last 2 years. And imagine that if every time the end of the year comes and your CPA says, holy crap, you're going to have a ton of taxes. Is there anything you can buy? So then you go and buy a whole bunch of crap that you didn't need simply to show an expense and decrease your profitability and thereby decrease your tax liability. How well do you think that's going to go when you go to a bank and try to prove to them that you have the ability to make a loan payment that you haven't gotten yet, and you have to be able to show you could have made that payment for 2 years before you ever go to get the loan? This should illustrate to you why a CPA isn't who you talk to about building your business. But people don't know this, and they're all cheap, so they talk to people who will give them information for free. So if I am spending less than I earn and I qualify for a loan, well, then the question becomes, if I don't spend all the money, where should I put that money? Well, for most small business owners, the logical thing is I ought to put it back into the business because that's where I have control and that's what I understand. Remember that when it comes to investing, broke people save, rich people invest. Well, if I have money less than what it takes me to live left over at the end of the year, should I put that money into one? Paper assets. You're well aware of them. The stock market, people's 401k, 403b, SEP, KEO, Roth, whatever. The second one would be investing into your own business. The third one would be investing in other people's businesses. And the last one would be investing in real estate. Well, paper investments over a period of time, given the ebb and flow, with a diversified portfolio, some in active equity investments like stocks, bonds, mutual funds, index funds, and some portion, 20, 30, 40% that are in bonds, you have a blended rate of return. And over your working lifetime, what can you expect to get? Probably between 6 and 8% over time. And just know the average investor over the last 50 years has actually gotten a blended return of 5.91%. So realize that 6 to 8% is actually a little grandiose compared to the average. So that's what you get. So the next thing is, well, I would never invest in the stock market. I need to have control over my stuff. And so I'm going to put my money into my own business. Okay, what's the rate of return? They have no idea what you're talking about. Well, I mean, my gross profit's like 30 or 40%. That has nothing to do with how much the business makes. Because remember that your income is something that you pay every single year. Most business owners either pay themselves way too much or way too little. Let's not look at either one of those things. Let's say that if we wanted to replace you, and I'm aware that every business owner will tell me, you can't replace me. Nobody will ever do what I do. Yeah, whatever. What will it take in real dollars to get 70 or 80% of who you are? Well, whatever that number is, now that has to be included in the profit cost to the business. So money that you might have thought was profit is now taken up by that number. Then the question is, what's left? Compare what's left after all of the expenses, including the income to replace you, against the gross revenue. I'm going to tell you that you'll be shocked at how many businesses do not even make 10%. But hey, if it is 10, 12, 15%, still beats the heck out of the stock market, and I have control. I can't argue with that. I agree, if that's true. But you better know that, and I'm going to tell you, if you line up 10 business owners, 9 out of 10 won't even know what that number is, much less what they should be shooting for. The next thing is to invest in other people's businesses, which I hate. Unless you got a seat on the board, you and the other investors can outvote the owner of the company. I would never do it. And unless you've got 30 years of experience as the CFO of somebody in that industry, I think it's a terrible idea. If you ever watch Shark Tank, you ought to know all you need to know about that. And that's from me at an MBA. Next option, real estate. Real estate is a business that you can make as much or more money than investing in your business, and it can potentially be more hands-off. Paul already made the point, and that is this. I don't ever want to manage property. So if you think about investing in real estate and the first thing that comes to your mind is you're going to have to fix toilets in the middle of the night, then you're not listening very carefully. Because when we vet real estate and its expenses, they will always include management. It will always include vacancy, and it will always include maintenance in addition to all of the other expenses. And you have to make a profit on top of all of that. Only then do we want to buy and purchase that real estate. But when and if we do that, that return on investment overall, which includes all of the components that potentially make you money in the ownership of long-term investment, not flipping, just so we're clear. People who flip houses don't invest in real estate. Earned income is flipping properties. That's not the same thing as buy and hold and creating wealth. They're totally different things. Most real estate agents will tell you they invest in real estate and all they really do is remodel and flip houses. It's not the same thing, period. So when I buy real estate, I am enjoying the benefit of long-term ownership, and someone else is buying me assets with their money. That's the primary goal. And the way I calculate how much I'm earning is, one, is there cash flow on top of all those expenses that will also include long-term capital cost of ownership that needs to be financially forecasted, and rarely is. You might know somebody who owns 10 or 20 properties and you ask them, what's the formula or factor you're using for long-term capital costs? And they'll have no idea what you're talking about. I can tell you that my son and I are hired by a large multi-billion-dollar equity fund, and we vet $100+ million properties, and we analyze every fixture in that property, its reasonable life cycle, where we are in the life cycle, and when a major repair or replacement is going to take place. And then we financially forecast the cash flow to determine if we'll have the money to fix that at that point in time. Talk to somebody who owns a single family home and rents it out. None of them even know what I'm talking about. So all that is in there. I know I've got cash flow on top of that. That's number one way I make money. Second way that I make money is if the value of the property goes up while somebody else is paying the payment on the loan, pays the property taxes, the insurance, all the maintenance and all the management, and the property's going up. My single family home is not an investment. That home, for me to enjoy, simply keeping pace with inflation. Let me be clear. Your real estate agent says, wow, you've really done well on this house. You've doubled your money. I have? Really? Well, why do you say that? Well, you bought the house for $300,000 and now it's worth $600,000. Wow. So I doubled my money. So does that mean I can sell that house and buy another one in the same neighborhood that's twice as nice as the one I just sold? Of course, the answer is no. You didn't make money. All you did was keep pace with inflation. And what they call appreciation isn't depreciation. It's simply inflation infecting the purchasing power or the cost of real estate. Right. In addition to that, you didn't even keep pace with inflation, because throughout that, to enjoy the benefit of so-called keeping pace with inflation, you were paying for property taxes, you were paying insurance, you were paying the interest on the debt, and all of the other expenses, including utilities, to enjoy that benefit. Imagine when I buy real estate, I pay none of those costs, and the property goes up right alongside the house that I live in. Well, imagine if I put 20% down on that home and I only put down 1/5 because that's what 20% represents. 20, 40, 60, 80, 100. So I only bought 1/5 of the house. Yet if the house goes up at 4%, is it just the 20% I paid for or the whole house? Well, of course, it's the whole house. Well, if each one of these components are equal to the 20% I put down and it went up by 4%, I'm actually getting 4% on each of the 5 components, i.e. 5, or forgive me, 4%, 8, 12, 16, 20. I'm making that money, and that is the leverage on the financing. That's how you make your money. Buying it with cash is not how you make your money. Because remember, if I am making cash flow and I pay down another component to the loan, what did I just do to the leverage? I decreased it. Wouldn't it have made much better sense to take that money that I got in cash flow, use it as a down payment on another one, and now I'm getting the same leverage on twice the asset value? That is lost on the average person in America who seeks to own everything with cash because they don't understand. Well, I don't understand what you're saying, but I just want to own everything and not owe anybody, and I'm paying off my house early. Horrible mistakes that they make. So that's the second way that I make money. The third way is every time I'm making a loan payment, I'm paying down a portion of the principal balance on the loan. So when you add the cash flow, the increasing value of the asset itself without having to pay $1 to make that happen, and the balance paid out on the loan that's improving my equity position, when you put those together, you're looking for a total overall return of at least 20% to make that happen. And if you get that, in addition to the depreciation and the tax benefits, it's hard for the business you're in to make that type of return as an offhanded investment. So very honestly, putting all your money back into your business may very well not be the best leverage for your investment dollar. And in fact, in some cases, it's not even worth a third of what you could get in real estate. So the reality is my business exists to create more money than I need to support my lifestyle so I can buy more assets using other people's money. That's the primary goal, Paul.
And that's the success formula right there. You just said it in a nutshell. Yeah, make money, spend less than I earn, and take that money and invest it in hard assets, real estate. By the way, I know that I read a long time ago. I looked at a lot of different investment strategies, and the writer of several books that I read, one of them in particular, I remember, he thoroughly convinced me that the single family home was the best investment in America. Because if the hits the fan, for a lot of people financially, they'll let the bank come and repo the car, but the house is the most important thing. So the renter would let their car go, but they're not going to let the roof over their head go. So, and then you've actually been, Robert Kiyosaki talks about this, and this is the first time I got all of Robert Kiyosaki's books, all of them. I've read them all. And
I've had Robert on my radio show, right?
That's why, by the way, I wanted to mention to the listeners, Todd's had Robert Kiyosaki on his show. So, but Robert's the one that first introduced me that your home is not an investment. It is not an asset. And he said it simply like you did. Who pays who? Do you get money from your home every month? No. Do you pay money? Okay. It's not it's not an asset, it's a liability.
Assets make me money, liabilities cost me money. So even when the house is paid off, it's still a liability.
Still a liability. So only the rental real estate that you purchase, which is good debt, because Robert Kiyosaki talks about this. He says there's good debt and there's bad debt. Bad debt's consumer credit, car loans, boat loans, home loans. That's all
cost me money.
Bad debt. Okay.
Good debt.
Good debt makes me money. So that's why, and good debt is owning 10, 20, 30, 40 homes, and you're in debt on all of those homes, but it doesn't matter. You're not paying the debt back. The renters are. Okay. And that's good debt. That's debt that makes you money. Robert Kiyosaki has become, I don't know, I think he's a billionaire, and he did it from buying apartment complexes. That was his favorite. and leveraging the bank's money. He's never ever used his own money. He's in debt. I forgot what he said. He's like hundreds of millions of dollars of debt that he owes, and he's like super, super wealthy because he used the leverage of the bank's debt, and the renter pays he just did it on a grandiose scale. Grandiose.
But let me say something about that because it's important. Folks, if you're listening to this, what you do need to discern the difference is that we're not talking about doing this with no money. I'm aware of all those so-called gurus on the internet who are going to teach you how to invest, buy real estate with no money, and I'm not going to argue maybe it can be done, but I'm going to tell you it's a hell of a lot easier when you have money to work with. And most banks in today's environment are going to require 20 to 25% down on these properties. And why then is everybody on the internet selling these courses to make money, by buying, short-term rentals and re-renting them and digital rental and all this crap? Well, it's real simple because they sell those courses for a modest amount of money and the average person can afford them. And if you ask somebody or tell somebody from the beginning, you got to have 20 or 25% down, you're not going to sell very many courses, are you? So if they want to sell 1 million courses, they got to talk to the average people who are absolutely broke and have no money to put down. I hope that's not who I'm talking to, because if that is, I'm telling you, your goal is to make more money. And for a lot of people, they don't like that. I'm working as hard as I can, making as much as I can. Well, too bad. You got to make more money than it costs you to live, because you've got to have money to put down and or solicit it from other people who do have the money. But it's hard to solicit money for down payment on real estate, even when you find it, because they want to know that you're solid and you know what you're doing. And the best way to do that is to do it yourself a few times first, and then you can more easily solicit someone who has the money. You find it, you manage it, you improve it and increase the rents relative to the amount you spend. And now you partner with them if you want to do that. But doing that, finding somebody when you have no experience and have no idea what you're doing, if you want my money, tell you what, it ain't going to happen. So it takes money to make money. I hate to tell you.
Sure. So, hey, Todd, I know that you can't get into this in detail. Todd he shared it with my wife and I. He has a very, very structured system of purchasing a property. So he knows long before he ever purchases it that he's not going to be paying money out of his pocket to make expenses on this house, to do the roof later on. So he has a very precise formula that he uses to purchase rental real estate. And you've never lost a nickel on rental real estate since you've been, right? Never, not once, right?
Well, a long time ago.
Okay, a long time.
I did. 30 years ago, I did.
So now, if you want to get in touch with Todd, please go to his his website, coveryourassets.money, and there's a contact link on there. Go ahead and contact him. But just real quick here, go over, because you have the drop to zero thing. That's the really quick way. So it's not the actual spreadsheet and formula that you gave me that automatically tells us. But go ahead and tell our listeners basically how they'll know whether it's a property that they want to attain or not.
Okay. Well, I think the first thing you have to do is determine fundamentally if it makes sense to spend your time looking into it.
Right.
And so there's very fast, down and dirty ways to get to some useful information to determine if it makes sense to go any farther. None of us want to waste our time. You're busy or we're all busy. Who cares if you're busy? We're all busy. So the reality is that the only reason you're busy is you think you make more money doing what you're doing right now than what can be made over here. And if I actually show you how that works, you might change your mind, but most of you probably just don't want to know. The reality is I have a one-to-one formula, which others use, or I call it similar things. I've just been calling it that for 35 years. It's real simple. I take a property and I look at the market rents as compared with the purchase price or the asking price to determine whether or not it makes sense to buy that property. So number one, if that property costs $300,000, number two is, what are the market rents? That assumes that I know the market and the sub-market of what market rents are for a 2-bedroom, 1-bath, 3-bedroom, 2-bath, or whatever the case may be. Well, if I'm going to pay $300,000 for it, all I do is remove the last two zeros on $300,000, put the parentheses around the remaining numbers, and that will show $3,000. If I can't get monthly rent of $3,000 per month, I'm probably not interested. Now that simple formula, that bottom buck, no bull type formula, is also called a gross rate multiplier. That gross rate multiplier, which is different than a capitalization rate, doesn't take into account the expenses or anything about the building. It just simply says, what is the raw revenue, the market rents or rent roll against the purchase price, and does it have any hope of being able to be successful from a cash flow perspective? If it looks good or it's close, now I'm willing to do more due diligence to delve into it to see more. So that's the fastest way to do that. Then I teach people about the long-term capital costs of ownership. I teach them about capitalization rate. Capitalization rate is a term that often is used to determine what type of return on investment you would receive should you purchase an income stream for this property. A lot of people, maybe they're retiring, they don't want to invest in real estate because it goes up in value. They want an income stream with the money they have to replace the earned income that they used to get prior to retirement. That's why cap rate is used most frequently, or it's used for that reason, because when you use capitalization rate, the formula takes into account that you're buying the property with cash and there is no financing. So there's no principal and interest payment, but there are all the other expenses, property taxes, insurance, and all the other things you pay. So the concept is very simple. If I were going to buy this asset with cash and I get a dividend, which is the cash flow minus all the expenses, what is that number that's left? And if I invested that money anywhere else, what would I have to receive as a rate of return to produce the same dividend that I'm getting on a monthly basis? That might be a 6 cap, a 7 cap, an 8 cap, which is the simple thing. It's the return on investment in the form of a dividend. Now, it doesn't take into account if the property may or may not be going up in value. It simply looks at the dividend return in the form of cash flow on a month-over-month basis, assuming that the property is occupied and you don't have any major expenses. That's a cap rate. Well, a gross rate multiplier that I described before, the lower the number, the better. And a cap rate, the higher the number, the better. Right. What am I looking for in a cap rate? I'm looking for a cap that's going to be 7 or 8%. I buy a property and I try to buy it with a cap rate of 7 or 8, but if I sell a property, I try to sell it at a 6 cap, because if the capitalization rate is low, it means I'm going to sell it for a high price. If the capitalization rate is high, the price is more in line with that. So I'd like to buy the property with an 8 cap and I like to sell it at a 6 cap. And regardless of what somebody's asking for a property, I don't care what they're asking because they're so silly. They think the market dictates that. No. What are the rents minus the expenses, creating the capitalization rate? And if I look at the current market price that you have listed on that property and it yields a capitalization rate of 4, I'll just keep lowering the price until it gets me to a 7 or 8 cap. And when I do, to me, that's what the price is, regardless of what you're asking. But see, most people come from a homeowner space. They're dum-dums. They have no idea how to look at this. An investor uses cap rate often, not always, because it's not the beginning and the end. It's only one thing, but often they use that to determine the value.
Right. And that's one of the things that you teach people. I know there's a lot of fancy terms going out that a lot of people probably wouldn't understand, cap rate and all this. But I mean, that's exactly what you teach, is how to 100% know before you go into a property that you're going to get that 20+% return consistently on that property, following the numbers that you teach people how to apply to those individual properties. And is that correct? Am I correct?
Well, I mean, it would be nice if we were 100% correct or no. I mean, there's always things that can come up, but let me put it this way, Paul. I hear people, well, forgive me, less successful people who will say things like, well, you know, if you want to succeed, you got to take risks. I so disagree with that.
Right.
I don't take risks.
That's the reason.
Numbers work or they don't work. The numbers are there to eliminate ambiguity. They work or they don't work. And when I buy a property, I don't buy potential and I don't buy opportunity. Every real estate agent on the planet wants to sell you what it could be or what the rents should be. I'm not interested in that. I'm going to buy it as it is, and then I'm going to do that. And that's what I bring to the equation. So if the numbers work, I'm interested. If the numbers don't work, I don't waste my time. It's that simple. And if you know how to do this, investing in real estate is not risky. But see, for everybody who says to me, any investment, no matter what I'm talking about, if they say to me, ooh, that sounds risky, all they're really saying is that they don't understand it and they're not a numbers person. Right. And every business owner who's listening to this needs to recognize that you're seeking to become a financial person, not even respective to your business. You want to be a financial person. I'm not interested if you're a good body technician. I want you to identify as an entrepreneur who knows numbers, because then you can make any business work. And when the numbers work, it's good. And when the numbers don't, it doesn't. Pretty simple.
Yep. So that's a great point that you brought up. So it's a way to eliminate risk. And Todd has a precise formula. Once again, go ahead and get in touch with them through the website. Anything else last minute? You've given us a lot of information, Todd, and I really appreciate it. Yeah, great. Get that basic formula. If the house is $500,000, you should be able to get $5,000 in rent. If you can't, don't even look at it. That's a quick way to figure things out. So you had mentioned always, if I'm a busy shop owner or whatever, you should have a real estate person who knows the neighborhood that you're looking at like the back of their hand. They know exactly how much those houses rent for. They know when they come up for sale. They know that when they come up before they even hit the market. And this is where, and then you have to be able to act fast, because when a deal comes up, it's never going to make it to the market, or if it makes it to the market, it's going to be gone quick. And so you got to have a realtor that you work with that knows this while you're doing your business and running your shop. Paul,
I'm impressed. You're absolutely right. You're absolutely right. So what he's talking about is markets and submarkets and being able to have access to the numbers. When a property works and the numbers work, you don't have time to screw around. You have to be decisive. And if you're incapable of being decisive, well, then you're never going to succeed at anything. I mean, the ability to put your blinker on and make a decision is everything. But in terms of my last words to your audience here, if you are, as I'm proposing, a business owner, or even maybe hope to be one day, you have a decided advantage over other people, in so much as you are only limited in income by what you choose. Now, what you do with that money, that's a big deal. But you do have a vehicle in a business that can accomplish those things that I talked about: earned income, asset value of the business, and then the business can buy you real estate with otherwise rent money. That alone puts you miles ahead of the average individual 401k speaker who works for a corporation making $200,000-$300,000 a year. They think they're killing it and they got it made. They have no idea that you can make that kind of income for what you do. And on top of that, you've got those other things. So that alone is huge, but only if you recognize it and you position for it. Right. In addition to that, the money that you invest is so well spent when you buy real estate and you hold it long term. It's hard to beat the value of an asset that doubles and triples over time, and it takes virtually none of your own money to support that happening. That's really, really a powerful thing. And there's not much that you're going to do that is better than that. And real estate has been successful for generations and centuries. And it's not a big surprise because it's not that complicated, but most people don't do it. So as a business owner, you need to recognize that you are in a unique position to take advantage of these things, but only if you actually identify them and you understand the true impact. When you see what can be accomplished, it's shocking. It really is shocking. I just recently helped a couple who bought a multi-unit property. It's not big. It's $1.2 million. But the numbers work. So here's the deal. If that property goes up in value at a modest rate of return because it is metro proper, metro properties tend to appreciate more but don't have as good a cash flow. You move out to the outlying areas of small towns, you might have better cash flow but not as much appreciation. But here's the thing, based on a modest appreciation rate of 5% per year, in 12 to 15 years, that $1.2 million property that we put down $240,000 on, that property is going to be worth at least twice as much, $2.4 million. Now, if that's true in 15 years, whatever the tenant has paid down on the balance of that loan, that's what's left to be paid off, and the property's worth $2.4 million. That transaction that we closed on Monday just took this young couple who are 35 and 37 years old respectively, and it converted them into millionaires, period. No question.
One small property.
That's right. That's right. And all that's going on while they're running their exteriors business.
Right.
And they're doing very well in that. But this is happening while that's going on. And what do they want to do? Buy more.
They don't want to buy a boat, a yacht.
Yeah.
Hey, Todd, thank you very much for your fantastic advice. It's kind of unusual to have a financial guy on a podcast like Top Shop, but I knew how valuable it would be to get your advice. 13 years in the industry, and someone who really knows what they're doing and is walking the talk. So he doesn't teach how to do this. He's not like if you don't know how to do it, you teach. Okay, no, that's not Todd. He does it. And has been doing it for a long time. In fact, the majority of all your homes are maturing now, aren't they?
Well, I don't have, I mean, reality is I'm 63 years old. If I were younger, I would be buying a lot more real estate with what I own today, because I'm literally not very many years away from having pretty much everything paid off. And I own 22 properties and 50 doors. So yeah. But my son, who's 35, that's what he wants to do.
Okay. Yeah. He wants to blow it up, doesn't he? Okay. That's quite a legacy to leave to your kids. Thanks for your time, Todd. We really appreciate it. Once again, everybody, coveryourassets.money. Go to the website, click on contact us, and give him a ring. He's here to his consultation services. He does consultation services as well as the podcast. And he works with an exclusive clientele that really want to do something with their money besides buy shit, like you said. All right. Thanks, Todd.
For additional automotive resources and exclusive content, follow us on Spotify and subscribe to our YouTube channel to catch all our episodes. Thanks again for joining us in the driver's seat, and we'll see you next time for another thrilling episode of Top Shop.